All right, hi everyone. Welcome to today's webinar where we'll be talking about trading the news, interest rate decisions. So you can guess this will be all about central banks and the respective interest rate decisions that they do. All right, just want to make sure you guys can hear me loud and clear and see my screen as well. You should be able to see this first page of my slides, IC Markets webinar, trading the news, interest rate decisions. And also do take note that we have the Q&A box and the chat box up as well. So please drop your questions in either of these boxes as well. All right, I see a couple of people have already signed in. Hi Ajay, hi David. Good to see you guys. All right, just let me see. Right, okay, let's just wait I'll just wait a minute or two for everyone to start tuning in as well. All right, we got more people coming in. All right, hi Latabo, hope I've pronounced that right. Mic is all right. Okay, yeah, just making sure everything is good. Are you guys able to interact with the Q&A box or the chat box, the chat window, sorry? Are you guys able to type any messages or questions in there? All right, hi Roderick, welcome. And raise. Okay, hang on. All right, okay, I think we're good to go. Right, just making sure everyone can hear me and see my screen as well. All right, and do take note, we've got the Q&A window up as well, so do drop your questions in there. All right, for those who have just joined us, today's webinar will be on trading the news, interest rate decisions. As usual, before we start, here's the disclaimer. All right, this is marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of solicitation for the transactions in financial instruments. The analysis contained herein does not constitute a personal recommendation. It does not consider your personal investment objectives, investment strategies, financial situation, or needs. Right. And also do take note of the risk warning that comes with trading CFDs and Forex. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Trading Forex and CFDs may not be suitable for all investors, so please ensure that you fully understand the risks involved and seek independent advice if necessary. All right. Okay, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you between a special partnership between IC Markets and Everest Fortune Group, where Everest Fortune Group has been the finalist for Best FX and FX research and equity research for the following years, 2019, 2020, and 2021. All right, so here's the agenda for today. Okay, so we'll just start off with a little bit of the basics. What are interest rates? Who controls them? Then we'll look at how interest rates impact markets and what is the intention behind central banks raising rates or cutting rates. And the third part would be how can we trade interest rate decisions. And the last one would be some a list of free resources that you guys can access in your free time to learn more about central banks and also macroeconomic data as well. Okay, so what are interest rates and who controls them? Okay, so just to break it down simply, interest rates are bank rates that are charged to domestic banks to borrow money, right? So basically each country will have a central bank and they will charge the respective domestic banks when they borrow money from them. All right. So then these domestic banks would then provide loans to institutions, businesses, households, and individuals like you and me at a higher interest rate to earn the income on the spread. Now, this income earned on the spread is known as net interest margin. And so this is how banks generally make money, right? So just to recap, or just to put it simply, the banks that we all know, our local domestic banks, they will borrow from the nation's central bank at a certain rate, and then they will loan that money out again to businesses, institutions, households, and individuals at a slightly higher interest rate. Now, this could be for your housing loan or mortgage loan, or for your business when you're expanding the business, or it could be a personal credit loan as well. And the interest that they and the income that they earn on the spread is called the net interest margin. All right, hi Jamilu, good to see you as well. Welcome back, and welcome to everyone else as well who has just started to tune in. Thank you for tuning in. All right, and of course, as I've mentioned, examples of loans could be a business loan, a mortgage loan for when you're buying your home, a personal loan, as well as a credit loan on your a loan on your credit card as well. Okay, so a nation's central bank sets the interest rate to implement or signal its monetary policy stance. That means it is either hawkish or dovish. So these two terms, I'm sure most of you will be very familiar with, especially when it comes to central bank talk, or the president or the chairman of a central bank, right? So just to break it down, when the central bank is hawkish, that means they are raising rates, and when they're dovish, they generally are cutting rates, or maybe keeping them on hold. So that's how we can interpret hawkish and dovish. Okay, so as we've said, the central banks are the ones that will provide liquidity to the financial system, and they do this by loaning out money to the domestic banks at a certain interest rate, and then these banks would then loan out the money again to other institutions at a higher interest rate, right? So, well, who are the key central banks in the world, right? So here are some of the key or major central banks around the world, starting with the Federal Reserve. Then we have the European Central Bank, Bank of Canada, Bank of England, Bank of Japan, Reserve Bank of Australia, Reserve Bank of New Zealand, and the Swiss National Bank, right? These are some of the acronyms that you may be familiar with as well. So as you can, if you guys do realize, all these banks are involved, that are listed here would comprise the US, the Forex major pairs. So like Federal Reserve is obviously the US dollar, ECB is the euro, so you have the euro ECB, euro dollar here. Then Fed and Canada, you have dollar CAD. Then you have the pound and dollar, pound dollar cable. Then you have dollar yen, and then you have Aussie dollar, Kiwi dollar, as well as dollar franc as well. Yeah, so these are all the major FX majors that you see here, and these are the main or key central banks globally. Okay, so how do interest rate decisions impact markets? Right, okay, so central banks have a very important part to play in financial stability, and the most influential and prominent central bank is the Federal Reserve, which is in the US. Okay, I think we all are well aware of that, and we have experienced it firsthand actually last year throughout 2022, when the Federal Reserve was aggressively raising interest rates, and we saw how quickly the value of the dollar rose, which impacted all the other FX pairs. And we could see obviously the dollar index rising very sharply. We could also see government bond yields, specifically the US government bond yields, rising very aggressively as well. So we've all pretty much experienced it firsthand, how influential the Federal Reserve can be when it comes to raising rates. And perhaps maybe next year we may very well be experiencing a situation or an environment where the Federal Reserve will be starting to cut rates, and we can firsthand have a experience on how markets are going to react to this. Okay, so basically, the Fed is tasked with maintaining a certain level of stability within the US financial system. Now, they do this by promoting economic and employment growth. How do they do this? They do it by implementing changes to the interest rates. So uh, in essence, the Federal Reserve maintains financial stability. They try to promote economic and employment growth, and they do all of this basically by the implementation of interest rates, right? Now, whether they keep rates on hold, they raise rates or cut rates, it all has to do with where uh, the economy is currently at, or which part of the business cycle or economic cycle we are currently in at. Okay, so so the Federal Reserve basically sets two types of rates, the target interest rates and the discount rate. Okay, the target interest rates is what we see uh, talked about most often, right? It is the rates at which banks in the US lend to each other overnight in order to maintain reserve requirements. So whenever we see or hear any news about the Federal Reserve raising the interest rates by 25 basis points or 50 basis points, they are referring to the target interest rate or the Fed fund rates. The other rate, which is the discount rate, is the rate at which banks can borrow directly from the Federal Reserve, right? It's just some background information. But just to take note, the rate that we are focusing on would be the target interest rate, which is otherwise known as the Fed fund rates. This is what is usually referred to when markets or media are talking about for the Federal Reserve raising rates. Okay, so just to touch on 25 basis points. So 25 basis points, just in terms of percentage, you just have to divide it by 100. So basically, it is one basis point is 100 of a percent. So if you have 25 basis points, you divide it by 100, you get a quarter percent. So basically 25%, 25 basis points means 0.25%. So whenever we hear Chairman Jerome Powell talking about raising the interest rates by 25 basis points or 50 basis points, they basically mean 0.25% or 0.5%, or quarter percentage point or half percentage point. Okay, that's how we can infer it simply. Okay, so if the Fed is hawkish, they will raise interest rates, and this will increase the cost of borrowing, making both credit and investment more expensive. Now, they do this when they think the economy is overheating, right? So they need to slow down the economy, and the only way they can do that is by raising interest rates. And by doing that, it has a knock-on effect on credit and investment interest rates, which makes things more expensive. So they're basically trying to not kill demand, but to temper demand, right? So when borrowing costs are more expensive, be it as an individual or as a household or a large business organization or small businesses, we will tend to think twice about taking out that loan for whatever intentions we had. It could be for expanding the business, it could be a mortgage loan on buying a new house, or a mortgage loan to buy an investment property, or it could be a auto loan to buy a new car or a used car, right? Now, if the Fed lowers rates, it makes borrowing cheaper naturally, which encourages spending on credit and investment. So this encourages all parties again, households, individuals, businesses, right? And this is to help stimulate a stagnant economy. Now, this usually happens uh, when we clearly see economic growth, GDP numbers falling, we see PMI numbers contracting, and also we see the unemployment rate creeping up. So as the labor market starts to crack and the unemployment rate rises, this is also a period where the Fed will generally start to lower rates. And of course, once a full-blown recession happens, that's when the Fed will be quickly lowering their rates as low as possible to the lower bound. And not only the Fed, but most other central banks around the world as well. All right, so what do we mean by an overheated economy, right? An overheated economy generally translates into or results in asset bubbles. Now, this could be in various forms. In 2001, we had a dot-com bubble where the tech stock market went into a huge frenzy. And then in 2008, we had the issues with the real estate mortgages, where home prices were rising pretty rapidly as well. And in 2022, the overheated economy can be related to the general high inflation that's experienced by everyone, right? And this was not only a US phenomena, it was a global phenomena that everyone around the world has experienced, and we still continue to do so at various levels and various forms. Okay, right, okay. So as we can see, this is a okay, before we get there, okay, we're going to go to Forex Factory to find out how can we find out the meeting schedules of the various central banks, right? So in the case of the Federal Reserve, okay, so here I'm on Forex Factory, so I've just selected the most impactful category. So this would bring up all central bank decisions. So as you can see here, okay, this calendar runs from 1st July to 8th of August. So we've had a few interest rates announcements made over the past 4 to 6 weeks. So July 4th, we had the RBA. We've also had the Fed, no, sorry, not Fed, the Fed on, sorry, RBA and Z on 12th July, and we had the Fed on 26th July. Yes, the Fed on 26th July. So by going to Forex Factory and filtering the data, we're able to find out the calendar for all the various central banks. And the good thing about Forex Factory as well, in addition to having a snapshot of all the dates for all the various central banks, you can also click on the respective folder here. You look at the folder icon, and if you click latest release, it'll take you to the FOMC website. So for here, over here, you will have the various years where they list all the meetings for that particular year, and not only do they list the schedule for past meetings and upcoming meetings as well, as you can see here, they will also include the statement that is released on the day of the interest rate decision. So for example, the last interest rate decision took place on 26th of July. So if you click on PDF, we are able to read through the PDF as well and quickly look to see what are the key or main talking points that was discussed during this meeting. And oh, sorry, and okay, let me go back. And also, you are also able to view the press conference as well. Of course, you can click on it and you're able to have watch the recap of the press conference, or you could also watch it live on YouTube. I believe sometimes most of the news media outlets would be streaming it for free live as well. And then of course the minutes. Okay, so minutes, if we look at it next week, we actually have the Federal Reserve minutes coming up. Okay, wait, let me switch to the end of next week. Yep, I believe it's 16th of August, Thursday. Yes, this is still July. Yeah, okay, so Thursday, 16th August, the Federal Reserve will release the minutes of its meeting, and then that's also highlighted here. So when it comes to interest rate decisions, there are, I guess, three main things to take note of when it comes to the Federal Reserve. One is, of course, when the statement is released. So when the statement is released, this usually takes place at about 2 p.m. GMT. So do take note, my time for this calendar is all on GMT time, UTC +0. So if you look at it, oh sorry, 6 p.m. Pardon me, 6 p.m. GMT. So Wednesday, July 26, 6 p.m. GMT, the Fed Funds press release, Fed Funds rate statement, Fed Funds rate and statement is released to the press at 6 p.m. GMT, followed by Federal Reserve Chairman Jerome Powell's conference that takes place at 6:30 p.m. GMT. So the first piece of news to move markets would be the statement press release, followed by the press conference at half an hour later. And then the third part that would have an impact would be the minutes as well, because the minutes would give further details into the insights of what the FOMC members were actually discussing, what they were contemplating, and what are their, I guess, more detailed outlook on the state of the economy as well as the future projections for monetary policy. So when it comes to the Fed, do take note there are three components to the interest rate decision. The first two take place on the same day, which is statement release at 6 p.m. GMT, followed by the press conference at 6:30 p.m. GMT. And then about roughly 3 weeks later, roughly 2 to 3 weeks later, the minutes are released, which can have the third part of the impact. Okay, so this is how we do it for the go to the Federal Reserve website to find out more about their statements, press conferences, and minutes, as well as to get an outlook for the calendar as well. Now, if you go to the ECB, it'll be a similar story. So the European Central Bank, or the ECB, released their statement on 27 July, right, where they raised their main refinancing rate from 4% to 4.25%. So this means this was an increase of 25 basis points. So if we go click on latest release here, so we are able to come here and look at what was covered during the meeting and the statement and the press release as well, right? And what are the key interest rates? So the ECB actually has three interest rates that they manage, but the main one that we're looking at is the main refinancing operations, which was raised to 4.25%. That is, which is also what is displayed here on Forex Factory, right? And similarly, after the statement release, we also have ECB President Christine Lagarde delivering her press conference as well, which takes place about half an hour after, right? So ECB timing is also fixed as well, 12:15 p.m. GMT, where the statement is released, and then followed by the press conference at 12:45 p.m., where President Lagarde's remarks and statements can have further ongoing impact on the euro. Now, this could be positive impact or negative impact, right? Similarly for Jerome Powell, if both of them are hawkish, extremely hawkish during their press conference, they are very likely to jawbone the currency higher, right? So basically, they're just using their hawkish rhetoric to push up the value of the euro or the value of the US dollar. So that is why sometimes we may see that although markets were, dollar, for example, the dollar did rise when the statement was released, but if subsequently Jerome Powell is relatively neutral or dovish during his press conference, this would cause the value of the US dollar to fall. That is why sometimes we may see a lot of high volatility in between the periods when the statement is released and the press conference. Similarly, this can happen for the euro as well. So when the main refinancing rate and the policy statement are released, we may see the euro trade in one way, but subsequently President Lagarde may have other ideas or different outlook, and her words and remarks could cause the euro to reverse whatever gains it had made earlier, right? So it's very important to take note of the two different components for every interest rate decision meeting and how they can impact each other, right? And also for ECB for the calendar, right? Okay, we can see. Hang on, just let me get the link for the calendar. Yeah, just give me a sec. Sorry. Okay, wait. Oops. Here we go. Okay. Okay, so this is where you can find the key ECB interest rates. So what we're looking at is main refinancing operations. And you can see how they have raised them over time. And for regards to the calendar for this, we should be able to find it. Over here. Okay. So just give me a second while I get. Okay. So with regards to the press conference as well, you can watch it online as well. You can go to the ECB website page here. Right, do take note of this link. Right, do take note of this link. Maybe I'll just paste it here as well. It might be easier for everyone to see, right? And copy as well. And also for Forex Factory, maybe for those who don't have the link. And of course for the Fed as well. Yeah, I just drop all the links here. So it's easy for you to guys to copy and paste it. Or you could just take a screenshot on your PC or laptop or tablet. Okay, then okay. And just one more thing. Okay, and then similarly, if we go to the Bank of England, for example, next, if we look for the Bank of England, they did raise the interest rates. Let's see, where is it? Okay, here. They raised it on. They did raise it very recently. Oh yes, it's the same week, was it? Oh yes, they raised it on 3rd of August. So similarly, if we click on the folder icon and then go to latest release, we are able to view the main takeaway from the policy meeting as well. How many interest? What did they? What is their outlook on inflation, as well as employment as well? And you can also see how inflation is also pulling back during has been trending lower in the UK as well. And if you go to, okay, you can see the economic outlook, current conditions as well, and as well as the future. Oh, where is that statement? Hang on, there is go here. Okay, so we can see how they raise interest rates, and we're also able to see the calendar as well. Okay, if you just search Bank of England calendar. So basically here, this is what we're looking for. Monetary Policy Committee dates for 2023 and 2024. So MPC, what we see here, right? MPC official bank rate is the Monetary Policy Committee, which is basically the equivalent of the FOMC, but for the UK. So if we click here, we are able to see all the dates, upcoming dates as well, with regards to interest rate decision for the Bank of England. So we'll put that into the chat as well. Right, so we can see when are the upcoming meetings. So basically, Bank of England has, I think, 8 policy meetings a year. 1, 2, 3, 4, 5, 6. Yep, 8 policy meetings per year. We just had one in 3rd of August, just about 5 days ago, last week, and the next one coming up is on 21st September. Right, so this is how we can track the dates for Bank of England as well. And it's very easy to fed. Okay, we didn't find the calendar for ECB, but basically for the ECB, it's pretty easy. Usually once the Fed has has their policy meeting, the next day usually it's followed by the ECB as well. All right, and then we also have the Bank of Japan. So if we go to Bank of Japan, which released it on 2nd, was it 4th August, or was it no? Oh, sorry, it was 27 July or 28 July. Okay, so 28 July, Bank of Japan also released their monetary policy statement. So we once again, if you click on the folder, or sorry, click on the folder for monetary policy statement, it will take us to the page where we have the list of confirmed meeting dates as well. So this is how we can get the calendar for the Bank of Japan as well. So I'll repeat that again. Look for monetary policy statement under JPY, right? BOJ Outlook report, BOJ monetary policy statement. Click on the folder, click on latest release, and it'll take us to the calendar, and it'll also give you the past statements and minutes for the respective meetings as well. Okay, so this is how we can use Forex Factory to access the various or the respective websites of the major central banks to find out more about the calendar schedule, as well as with regards to the Fed, more specifically about the statements and the press conference and minutes as well. Right, this is how we can use Forex Factory. It's pretty much a one-stop resource tool to find out more about the calendar schedule for each respective bank. Okay, next on is right. As we all know, inflation was rising rapidly. So this is the US CPI data chart for the last 20 years. So up till June 2022, CPI peaked and has been falling quite rapidly. So during this period, even though the central bank, even though inflation was falling, headline inflation was falling, central banks, especially the Fed, was still raising rates. But if you had if you had noticed that after June, in the second half of 2022, the value of the US dollar actually started to fall despite uh, the Fed continuing to raise rates. We also saw the core CPI peak in September 2022 and fall gradually as well, although not as fast as headline CPI, but it started to retreat. So we could see that inflation had already peaked and had started to fall, but the Federal Reserve was still raising rates. Right, as you can see, this is the chart of the Federal Reserve Fed funds rate, and they've been raising it very aggressively. This is the most aggressive rate hike cycle in probably in recent years, I would say, and they've reached already 5.25%. Oh, sorry, 5.5%. Sorry, the current upper bound stands at 5.5%. Okay, how can we now that we've got the background of the central banks where we can access most of the resources, what are the key macroeconomic events to watch out for? So naturally, one would be the changes in interest rate decisions, then also what we call a deviation from normal monetary policy action, example, central bank intervention. This was something that took place in November of 2022 as well, and this was done by Bank of Japan. We'll go into more details about that. So it's also important to take note of any intervention news by central banks, because this actually has a great impact on currency markets, and we'll go through the example in the next few slides. So do take note of what should we look out for. Basically, we want to see when central banks are aggressively raising rates, or do we see a difference in monetary policy divergence as well? So what do we mean by that? So that means when one central bank is raising rates while the other is not. So an example of this would be the Bank of Japan again, where despite high inflation, they kept their policy rate at negative 0.1% while all the other major central banks were raising rates. So in a scenario like this, it is very likely the yen is going to be weak against most of the other currency pairs. And then also we would look at changes in inflation growth, which is what we looked here, right? First half of 2022, inflation was rising aggressively on an annualized basis. After that, it started to slow. It was still increasing, but at a much slower pace. And this is also around the same time when we saw the value of the US dollar start to fall as well, despite the Fed raising rates. So this is how we can use information, inflation data information, to try and see what is actually happening in the economy. So for the US context, we are looking at CPI. So how do we access this data? All right. So if we go back to Google, and if you just simply type BLS CPI, so BLS is basically the Bureau of Labor Statistics, and it will take you, the first hit will definitely be this CPI home, and actually we all know CPI is Consumer Price Index. So if you click on charts and then select the second line from the drop down menu, we're able to see the year-over-year change or 12-month percentage change for headline CPI. So all items is basically headline CPI, and as we saw, it peaked in June at 9.1%, and the last reading for June shows CPI slowing to 3% on an annualized basis. Similarly, if I click on all items less food and energy, this would give me readings for the core. So we can see the core peaked a bit later in September, and then it started to fall, but not as sharply as the headline reading. So this is part of the reason why, despite headline CPI retreating quite sharply, because the core was not falling as quickly as possible, or not dropping as sharply as the headline. That is part of the reason why the Federal Reserve continued to raise rates in the second half of 2022 as well as the first half of this year. But we've actually seen price action gone the other way, right? And we'll be looking at that pretty soon. So this is how you can access the CPI website just by simply typing BLS space CPI into Google, and the first hit will be the CPI website. Right. Okay. Then yeah. Okay. So we look at CPI, look at Fed funds rate. Okay. Then changes in inflation growth, and also we'll try and also look at tracking GDP and PMI numbers. Okay. So what I talked about, central bank intervention, right? So as you can see the dates here, this news was covered by mainstream media and finance media as well as your local media. You don't have to subscribe to any paid subscription services to get data like this, because even your local finance or business newspapers or news outlets would have covered the story. So basically this means this report is showing us that Japan spent $42 billion in October to prop up the yen. So basically this is a central bank intervention. So what had happened was the Japanese yen was being devalued very strongly because the Federal Reserve was raising rates, and because of that they had to intervene in the open market, and they did that by selling their foreign reserves. So Japan, Bank of Japan holds a lot of US dollars and US treasuries, so they began to sell that, and from the proceeds that they had from the sale of the US dollar and the treasuries, they used it to buy up the Japanese yen in the open market. That is why we saw the value of the US dollar fall quite rapidly from November onwards, or the last quarter of 2022, together with so if the US dollar is selling off, naturally dollar index is falling and dollar yen will also fall. Right, so this is what we mean, intervention. So this can have a deep impact on currency markets, even though we have the Federal Reserve raising rates, right? So in the first half of 2022, if we just go back, I'll just quickly show the charts, right? Okay, so this is 2022 here. So up till September, October, we saw the dollar index rise very rapidly. Naturally, there's going to be pullbacks along the way, but because the Federal Reserve was raising rates so aggressively, we saw the dollar index rise. But because of the intervention measures done by the Bank of Japan, despite the Fed continuing to raise rates, the dollar index actually fell. And this, we can see this in the value of the dollar yen as well. Right, once the intervention measures were announced and they actually started to buy up the yen in the open market, you could see the value of the yen rise. So that means dollar yen will be falling rapidly. Okay, so just before we get to that, so in the current context, it is important to track CPI data, headline CPI data, as well as core CPI data, and where it's where it's heading. So you can see June is at 3.3%, core is at 4.8%. So we can search on Google BLS CPI, so we can track the CPI data ourselves. Then also it's also important to look at the PMI data for the US. You can simply type this into TradingView. You can just type US composite PMI. You should get this. You would find this data point, economic point on the on TradingView, and we can also see that composite PMI basically is manufacturing and services sector. So we can see that in August onwards, economic growth actually started to rebound as well, and then that gave the Fed, uh, I guess, confidence to continue hiking, as together with NFP data as well. NFPs have been growing pretty steadily. Plus, unemployment data has also been unemployment rate has also been low. But now we see US composite PMI starting to turn lower. Do remember, any reading above 50 is expansion, a reading below 50 is contraction. So if that was to happen, we may finally see the Fed start to hold rates, and especially if the unemployment rate starts to rise as well. Okay, another good website for calculating target rate probabilities is the CME FedWatch tool. So you can simply type CME FedWatch tool, and it'll take you to the first. This is the first result would be the website that you want to go to. So here they give you the target probabilities or latest probabilities for the target rate. As we mentioned, the target rate is the Fed funds rate. So the current target stands between 525 and 550 basis points, or in other words, 5.25 to 5.5%. So what this means here, what this 85% means here, it means that there's 85% chance of the Federal Reserve keeping rates unchanged for the meeting that's coming up on 20th of September. Okay, and there's a 14% chance, a 14.5% chance that they will raise the target rate by 25 basis points. So if you look at 550 going up to 575, there's 25. So there's 25 basis points. So, but the probability of that happening is very low, and the probability of them keeping it is very high. So a lot of times, by looking at this early enough, we are able to see what the market is already pricing in. So even though the Fed may be raising rates, we may already see what the Fed has already raised rates at the past meeting, but we already know what they're likely to do at the next meeting, right? At the upcoming meeting. So using this website gives us a good idea into what are the probabilities for the next target rate and how much of it can already be priced in. All right. Okay, just a quick breakdown of what is the US dollar index. The US dollar is an index that weighs or measures the value of the US dollar versus a basket of other currencies, and usually is the main trading partners of the US. So the euro makes up 57%, Japanese yen 13, pound sterling 11, and so on and so forth. Okay, so here is the daily chart of the DXY, and these horizontal lines are the dates of the FOMC meeting in 2022 as well as 2023. So as you can see, for most parts of 2022, especially till the 15th of June, or at least till mid-July, the value of the dollar index always rose ahead well before the interest rate decision, right? So for the first 6 to 7 months of 2022, of course, you can also perform your technical analysis as well, right? And you can see that before each meeting, actually, the value of the US dollar rose pretty sharply going into the meeting, right? So a lot of times you can say that the move is already priced in. There's no point waiting for the interest rate decision to take place and then thinking, oh, okay, they've raised interest rates. Jerome Powell sounds hawkish, so let's go long on the US dollar. That's probably not the way to trade, because as you can see, for most parts of it, once the decision has taken place, you could see price actually start to pull back. So this could be a variety of reasons. This could be people just taking, traders or institutions taking profit. It could be a case where during the press conference, Chairman Powell was probably neutral or not as hawkish, so that's why the dollar index sold off. So it's a variety of things, but generally for the first 7 months of 2022, buying the dollar ahead of or buying the dollar index ahead of central bank meetings will prove to be pretty profitable. And of course, we can perform technical analysis on our on the dollar index chart to find suitable entry points. So do take note, that's how this played out. And as you can see here, November onwards, remember we had the intervention news by Bank of Japan, right? So they started in the news was started to be reported on 1st November here. This was covered on 23rd October. So towards the end of October, early November, news media outlets were picking up the intervention news measures. And that is when you can also see the value of the dollar index fall rapidly. So this fall in the dollar index was caused by the intervention by Bank of Japan. So although the Federal Reserve was also very aggressive or continued to be very aggressive, the value of the dollar index fell. So it's important to take note of what the major central banks are doing, because it can have an impact, major impact on how price previously used to trade. And we also saw that in June onwards, CPI, headline CPI started to peaked in June around here, sorry, peaked in June and started to fall, but the Fed still continued to raise rates, dollar index continued to rise. But then we also saw core CPI peak in September and start to fall as well. So when the core started to fall and then added by the intervention measures, we also saw dollar index falling. So similarly here, 2023 has been pretty hard to trade interest rate decisions, because you can see it's not a clear move, right? Even though the Fed did continue to raise rates at each of the meetings in 2023, it was not like 2022 where you could have bought the value of, or you could have bought the dollar index or dollar yen or shorted the euro dollar ahead of the Fed meetings. So this time around, it's all very technical based as well. Technical analysis will help you better, but do take note that how the dollar index has been trading prior to each of the 2023 FOMC meetings. It's not actually rising before. It's a lot of play to do with how inflation is also falling. So a lot of the news this year especially has been driven by CPI data and PPI data, as well as unemployment changes as well. They've actually been a more dominant force with the direction of the dollar rather than the interest rate decision. So do take note that this is the theme that we are seeing more in 2023. Whereas for the first 7 months of 2022, the prospects of interest rate hikes actually made going long the dollar much easier. But this time, especially for 2023, we are seeing CPI data, softer CPI data, cause dollar index to fall, while we see strong employment figures such as weekly employment claims or non-farm payrolls push the dollar higher. So you can see it's much more of a seesaw price action. And then this is how we have to use our technicals as well as take note of the data points that we mentioned. Okay, so I talked about employment change. So how do we look at that? So once again, go to Forex Factory. So if we look at, okay, good thing about employment claims figures is that they are released every Thursday. So this happens at, okay, let me just filter to 24th, okay. So what we are looking for, okay, CPI data is released on a monthly basis. So we can see, we can search for that on CPI as on Forex Factory. But what we're looking for now is what we call unemployment claims. Okay, so USD unemployment claims, they are released every Thursday at 12:30 p.m. GMT. So what is this data and what does it mean? So unemployment claims basically means the number of people who file for unemployment benefits. That means people who may have lost their jobs recently and then are now filing for unemployment benefits. So if this number continues to rise higher, that means more people are filing for such benefits, That means the labor market is starting to crack, and that should signal to the Fed that they should stop hiking rates so aggressively. And this also has a negative impact on the value of the US dollar. So if unemployment claims are rising or start to rise in the future and also come in higher than the forecast, that means the value of the US dollar should be dropping. So this is a negative catalyst for the US dollar. Similarly, as what we saw since the end of June, uh, unemployment claims were dropping, and not only were they dropping, they were actually coming in lower than their forecast. So in a scenario like this is a positive catalyst for the US dollar. So if we go to uh, the dollar index chart, if we just take a note of 22nd June onwards, so we just zoom in, so if you can see 22nd June onwards, you could see, yes, the dollar index start to rise. And then because this was with dropping unemployment claims acting as a positive catalyst. But what happened 7 July? I believe we had CPI data around this period. So if we look at, hang on, just yeah, let me go back to, okay. Did we have CPI data? Wait, this was 7 July. With CPI, US CPI data. Oh, okay, sorry. CPI data came in on 12th July, but 7th July, okay. Joel's opening data. So this is also a monthly data point that comes out. So this shows the number of job advertisements in the US. So this number came in at 9.82 million, which was lower than the forecast and also lower than the previous month's reading. So when this number comes in lower than the forecast, it generally means that there's less hiring activity, and this means that the value of the US dollar should fall. So this is partly one of the reasons why we saw dollar index start to fall from July 6 onwards, and this was accelerated the following week when we had CPI data which came in softer, right? Softer means it came in lower than the forecast and the previous month's reading. So we saw core CPI on a year-over-year basis fall. We also saw headline and core CPI data fall on a year-over-year basis. So when that happened, we saw a huge sell-off in the dollar index. So this year, data points such as the CPI data here, right? Core CPI, PPI data as well, which is released on 13 July. We also have CPI data, which is released the day before. So CPI data, PPI data, the softer PPI and CPI data have actually caused the value of the dollar index to fall, while we have data such as unemployment claims, which is here every Thursday. This comes out on a weekly basis. So when you have unemployment claims falling and coming in lower than the forecast, this generally creates a bullish catalyst for the dollar index. Okay, now let's see what's happened recently, right? So we all know on 26 July, the Federal Reserve raised interest rates, and then they were also, Jerome Powell was hawkish, and also the last couple of days, we've also had the other various FOMC members. Let's just scroll up to recent times. We've also had FOMC members right. We've also had FOMC members speaking as well. So with this Patrick Harker, we've also had Michelle Bowman speaking as well. Where is it? She was here on hand. We did. Okay, wait. That's the thing about Forex Factory. With regards to speeches, it is quite yeah, they don't list some of the speeches as a higher category. So if you go back, we've also seen hawkish talk by the various FOMC members in recent weeks. Where is it? Let me see. Yeah, that's it. Bowman. Bowman is actually one of the governors, Michelle Bowman. She's not only an FOMC member, but she's also a governor. So her her speech carries or her remarks carries a lot of weight, right? As you can see, Bowman again says more hikes may be needed to lower inflation. This was 18 hours ago, so just yesterday she started talking as well. So you can see a lot of the price action in the dollar index now is being moved by such economic data points or speeches rather than the actual interest rate decisions as well. So do take note of that. We had a very different trading approach in 2022, where before each interest rate meeting, the value of the price, the interest rate hike was already being priced into the value of the US dollar before the meeting. But this year, especially for 2023, we are seeing the economic data points having a seesaw effect on the value of the dollar index. Okay, so do take note of that. We have hawkish statements by FOMC members pushing up the value of the dollar index. We have strong employment data pushing up the value of the dollar index, but we have softer CPI data, softer PPI data that is causing dollar index to fall as well. So it's a lot of a push-pull relationship. So just trading the interest rates, especially for 2023, based on the fact that, oh, the Fed is going to raise rates, so I'm going to go long. That's probably not the way to go for this year. So once again, use the technical analysis to complement the fundamental data, and it's actually quite important to interpret the key fundamental data that is actually acting as bullish and bearish catalyst for the dollar index. So once you know how the data has an impact on the dollar index, naturally we're able to see that impact play out in the euro dollar as well as the dollar yen too. Right. Okay, let me see with back to slide. Okay, just to recap, maybe for those who have missed it, the key macroeconomic data that we need to watch for the US, which ultimately affects interest rates decisions. One would be, all right, CPI data. Okay, that's coming up next week. Oh, sorry, it's coming up this week, Thursday. So do take note of that. Okay, CPI data in the US. So if you look here, right, it is very likely CPI data is continuing to fall. So we look Forex factory, the year-over-year change is 3.3%. Oh, it's actually forecasted to increase. And this could be something to take note of. This is something quite different to previous forecasts. So as you can see, the year-over-year change has been dropping. Previous reading was 3.3. Now the forecast is for June's reading dropped to 3%, but July's forecast or estimate is set at 3.3%. Now, if the actual reading does meet the forecast, or worse, it comes in higher than the forecast, then it's quite likely we're going to see the value of the dollar index rise further. So do take note of this update in the CPI forecast, right? So if you look at the charts, headline CPI has been falling steadily. Core CPI, although it took a while, it's also starting to fall steadily. But this current estimate for July's reading shows an increase. Now, this is quite a big change in the analysis, because this could potentially mean we could see dollar index continue to rise higher in the second half of the week. All right, so CPI data is important, as well as PPI data. This comes out on 11th August, 12:30 p.m. GMT. So similarly, we can see this is a monthly reading, but if we click on, if we just type BLS, PPI, right, same thing, it takes us to the Bureau of Labor Statistics, PPI page, click on charts, right, and then click on the second category, PPI final demand 12 month. So you can see PPI has actually decelerated very, very rapidly and is continuing to do so. So if PPI data does come in softer here, we may see dollar index pull back a little bit. The other point is unemployment claims if unemployment claims continue to start picking up, that means this is negative for the US dollar, and then we should see dollar index pull back. So it's quite okay. 10th August is going to be pretty interesting. It's going to be pretty interesting because we have an estimate for CPI to increase, and if we have unemployment claims also come in stronger than expected, or also weaker than expected, right? That means if there's less people claiming for benefits, unemployment benefits, this is positive for the dollar. And if CPI comes in strong, this is also positive for the dollar. We could see a very strong bullish catalyst for the dollar index. But if we see a mix readings, then it could go either way. That's quite difficult, right? If it's a mixed reading, it has to say which component plays a bigger part in the direction of the dollar index. All right, so just to repeat, watch out for PPI data on a monthly basis, CPI data on a monthly basis, unemployment claims on a weekly basis, as well as non-farm payrolls and other job-related data, because that's what's uh, driving the direction of the dollar index this year. And naturally, this would have the impact. So if dollar index is going to rise, we can expect dollar yen to continue to rise further. And of course, if CPI data is strong this week, we could see the euro continue to fall, as well as pound dollar continue to fall with it, right? So do take note of this. This is how we would try and trade interest rate decisions this year, rather than just going long before the interest rate meeting, before as what happened in 2022. 2023 is actually very different in terms of the trading approach and trading strategy. It's a lot about focusing on CPI data, unemployment claims, PPI data, and the other jobs related data. Okay, so do take note of that. It's a bit more I guess fun analysis of the fundamental data, and then complementing that with your technical analysis to find suitable entry points, be it long or short. Okay, this is the US dollar yen, right? And also, what another thing to take note of is to track the government bond yield, such as the US 10-year bond yield and the dollar index. So this is the weekly chart. So these orange lines represent the peaks in the 10-year bond yield, as well as the peak in the dollar index. So as you can see, when bond yields peak and start to fall, usually the dollar index is also falling. Similarly, when the 10-year bond yield is rising, we can see the dollar index rising as well. So this is also important to see where this relationship holds through. So because bond yields will generally help us give us some direction into how we expect dollar index to trade as well, right? And also we can use moving averages as well as the Ichimoku cloud to see whether we're in a bullish trend or bearish trend. So clearly, after the intervention measures in October by the Bank of Japan, we also saw inflation start peak and starting to fall. We could also see it on the technicals. This is on the dollar index daily chart. We could see dollar index break through the cloud, and not only break through the cloud, but trade under the 50-day moving average as well. So once we see we saw a big fundamental change in terms of policy action by the Bank of Japan. We also saw a big technical breakout in terms of the Ichimoku cloud, as well as the break of the 50-day moving average, signaling a potential reversal for the dollar index. Right, so similarly, we saw this in dollar yen as well. And now we can see, although the dollar yen broke through the 50-day moving average, it found support just at the top of the cloud and is starting to go higher as well. So of course, I mean, these are not the only technical indicators that you should use. You can combine this with your other technical indicators that you're already familiar with. This could be Fibonacci retracements, they could be MACD, right? What is important is to understand the technical indicators that you use and make sure you can complement them together to help you identify high probability entry points. This could be short positions or long positions as well. Okay, this is of course the euro as well, so you can clearly see the reversal in trend as well. Euro dollar breaking through the cloud as well as breaking through the 50-day moving average to go higher. This was when the dollar index was selling off rapidly, so naturally the euro dollar will rise. Right, okay, so this is some of the resources that I would say that we've gone through today, right? So do take note, Forex Factory is a one-stop resource page where you're able to see all the economic data points as well as central bank meetings and when they're being released. And not only that, they also provide you with the link to the respective page as well, right? So you can go to the FOMC page, website page, ECB, Bank of England. Similarly, you can also go to the CPI page as well, right? What I showed you is how we can Google on BLS, CPI or BLS PPI, and go straight to the respective website. But if you go back to Forex Factory, and if I click on CPI, the folder icon, I click on latest release, it takes me to the latest release or the latest press release. But don't worry, to access the chart page, of course, everything's easier to visualize on the chart. This is a table format, but if you scroll all the way to the bottom and you click on news release charts, it takes you to the same website that I showed you earlier, right? Just a slightly different way of accessing the website, but everything's available on Forex Factory as well. So that's the good thing about Forex Factory. It has the links for all the respective economic data points as well as the meetings, right? So okay, I'll go back to this page as well. Yeah, so do take note that you can take a screenshot of this page as well as what I've written in the chat box as well. You can copy those links as well. All right. Okay, so I've come to the end of today's webinar, but just to take note, a lot of trying to trade the interest rate decisions for 2023 has, I would say, probably nothing to do with the interest rate decision itself, but rather than the economic data that comes out before and after each decision for the FOMC meetings, right? So basically look at employment numbers, which come out, unemployment claims rather, that come out on a weekly basis. Look out for CPI and PPI data, which comes out on a monthly basis. We have that coming up on 10th and 11th August. Look out for ADP data, NFP data as well, right? These are the data points that are actually driving the direction of the value of the dollar index rather than the interest rate meetings itself. And also, of course, do take note of the speeches by the respective FOMC members, especially if it's a board governor. They have a higher prominence in the committee, so their words and their remarks carry a lot of weight, and they're likely to push the value of the dollar index higher, as what we saw yesterday. Governor Michelle Bowman being very hawkish again, which is part of the reason why we are seeing the dollar index climbing higher over the last couple of days, right? Okay, so with that, I'll just come to the final disclaimer. So, right, do take note, trading Forex and CFDs carry a high level of risk to your capital, and you should only trade with money you can afford to lose. So trading Forex and CFDs may not be suitable for all investors. So please ensure that you fully understand the risks involved and seek independent advice if necessary. All right, hi Roderick. Okay, yeah, do take note on these webinars are usually uploaded onto the IC Markets YouTube page. So either go to IC Markets Global or IC Markets Australia on YouTube, and you should be able to see this webinar being uploaded in a couple of days, if not by the end of the week. All right. And also, if you guys could just kindly give your feedback as well with regards to this webinar. I've just launched a poll. Your feedback is truly appreciated, and we've also got a short survey at the end of the webinar as well. Just a few simple questions. I hope you guys can give us your feedback as well, so that really helps us to bring new topics for all of you, as well as try and improve our any previous content as well. All right. Okay. All right. Okay. Thank you everyone for tuning in today. It's been a I hope this has been a very informative session for all of you. So for US dollar trading or interest rate decision trading for FOMC, do take note of, I'll just repeat it once more. Do take note and highlight of CPI data coming up on Thursday, 10th August, which is on a monthly basis. We have unemployment claims which come out every week. So this is also quite an impactful catalyst for the dollar index. We also have PPI on 11th August coming up. And of course, we have NFPs, which came out last week, Friday, 4th August, right? We saw NFP numbers posting 187,000 job gains versus the forecast of 205. So this weaker NFP number actually caused the dollar index to sell off as well. So do take note, it's a lot of the economic data points that are actually driving the direction of the dollar index, and naturally it plays out into the other FX major pairs as well as the direction of gold as well. All right. Thank you everyone for tuning in this week. Do keep an eye out for all our future webinars by myself or by my other colleagues. And also you can catch the webinars once they're uploaded onto IC Markets YouTube page as well. All right. Thank you everyone, and have a great trading week and best of luck.